Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
This is part 2 of Cummins. We are talking about this company called Cummins, based out of Indiana. They make diesel engines and power generators. If you haven't caught our first episode, please do before you jump onto this one. All right, Hari, you want to start us off with a disclaimer?
Yeah, this is the Value Investor TV podcast. We are a podcast that helps you understand the concepts behind value investing. We are not financial advisors, nor do we know your specific financial situation. So if you are making financial decisions, please consult with the appropriate advisor before doing so.
Great. And as we always do with companies, we go through a checklist. And the second part of the episode is always about the second half of the checklist, which is financials, management, and valuation. So we'll talk about those three things in this episode.
Yeah.
All right, I'm ready to start when you are, Hari.
Yeah, let's go through it. So we had talked about the moat in the previous episode and kind of recapping it for people. The moat had a stronger. We had seen their moat kind of had a high switching cost to protect them, and really that was kind of where we anchored our moat to, and we saw a little bit in the way of risks as far as regulatory, and potentially that some of their suppliers are providing a great deal of their components. So, we want to also look at how that moat, though, because at the end of the day, if it doesn't turn into cash, it doesn't matter. So how does the company translate the moat that they have into a return on capital? And what does that return on capital look like?
Yeah, so in terms of capital efficiency, I looked at two different metrics. One is return on equity, and then return on capital employed. Those are two different relevant and very related metrics, but it measures slightly different things. So I looked at those two metrics for this company. So return on equity, last year, 2019, it was at 30%. The year before that, 29%. The year before that, 2017, it was around 13%. And then about 20% the year before that. So we're talking about somewhere around 25 to 30 range on average, return on equity. And if I look at return on capital employed, the number is around around 20%. So last year was 21%. The year before that, 22%. The year before that, 2017 was 20. The year before that, 2017, the return on capital employed was about 19%. So somewhere around that range, 20%. So I would say, we always use a discount rate of 10%. We assume that, we can get about 8% with S&P and just buying a basket of stocks. Here we're talking about return on equity of about 25%, and then return on capital employed of about 20%.
So I mean, it is pretty fantastic, those numbers. So I mean, let's keep going through this and just make sure that the rest of the financial situation looks okay, and then we can talk about management and valuation. So for those of you who are wondering where we're coming up with this, we're using our checklist that you can get if you send us an email, info@valueinvestor.org, have access to that and then follow along with us. So moving on, the financials, does the company have enough cash to maintain its business? And maybe, give us some numbers there, and, what's that cash in relation to their overall market cap?
Sure. So just to level set, I want to give you market cap first. So market cap on the time of this recording, and again, we are recording on the 25th of May. The market cap is about $22 billion. So that's kind of the size we're talking about here. In terms of cash, so the question here again, just to repeat, is does the company have enough cash to maintain its business? So in order to kind of answer that question, I look at a few things. So the first thing I look at is just the working capital, the current ratio. Another ratio I like to look at is quick ratio. So if I look at that, so working capital, what that is you're talking about the current asset minus the current liability. And so if you look at that, the current working capital right now for this company is about $3 billion, and then the current ratio 1.5. And in terms of kind of the long-term debt, so more of a long-term, if we look at that, long-term debt is about $2.3 billion. And if you put that into perspective of the free cash flow, you are talking about. Give me one second. I'm just looking at this number. Total debt of $2.3 billion, and then free cash flow last year after capex is about 2.4.
Okay, so about one time free cash flow.
Yeah,
So, that's the debt levels are pretty reasonable there, and
yeah.
um,
It's very
you know,
it's very reasonable, and I like to kind of think about it in two different ways. One is short term, and one is long term. I think long term is something that we consistently have mentioned in our podcast. We always look at free cash flow to the debt ratio, but I think short term is also important to consider in the face of coronavirus, in the face of cash crunch that some companies might be in currently. So I like to look at both, and in both fronts, they look pretty healthy, in my opinion.
yeah, and I guess you know the financials that you're using here are the annual report, but the quarterly report may look very different based on how bad their orders drop and things like that as
Yeah,
well. So
sure.
we'll keep going through here, talking a little bit about management.
Hmm.
So the question that we have here around management is, are management properly incentivized to protect shareholder interests over their own? So, what do we see there as far as how are they compensated?
Yeah, so the compensation, obviously, I think this is the case with all of the companies that are publicly listed. You have the short-term incentive structure and the long-term incentive structure. What we like to see, Hari and I, what we like to see is really focus on the long-term shareholder return, right? We don't want people to be juicing up their returns by buying back a whole bunch of stocks with borrowed money at a high price. We don't want that misalignment in shareholder interest. So that's what we look for here. And I like to read a couple of things here. So it's interesting. They use for the short-term bonuses, they use what's called RONA, ROANA. It is what it is earnings before interest and tax, depreciation and amortization, so EBITDA, divided by average net assets. So that's
Okay.
what RONA is, and they didn't use this. They didn't use this before. They just started to use this recently. Prior to 2018, they measured RONA performance using EBIT instead of EBITDA. So they switched from using EBIT as a numerator to EBITDA as numerator starting in 2019. So that's as we talked about in our prior episodes, that's a red flag for us. You always want to use EBIT more than EBITDA. And in terms of long-term performance measurement, they look at ROIC, return on invested capital, as well as EBITDA. So those two things. Again, EBITDA comes again here. So ROIC and EBITDA, and then RONA for short-term performance.
Yeah, and obviously, for people who don't understand why we wouldn't want EBITDA used, and the it's seemingly now expanded the use of this after I think it was 2018. They changed the gap accounting rules to include the gain and loss of stocks that have been sold. Has affects your net income. So a lot of companies were using EBIT, or were either using net income, for earnings per share. But now, if you own any marketable securities, you have to adjust your earnings based on that, even though you're, to balance the change in the asset side of the house. But the problem with that is then it makes very lumpy earnings, but it's not a cash charge. So that logic has been applied to this concept of EBITDA, which is the earnings, before interest and taxes, but also before depreciation and amortization. And a company like Cummins has a very high depreciation cost because they're a manufacturing business, and so their depreciation is actually a real expense, and it should be treated as a real expense because ultimately that expense has to be replaced by newer products, and so on. So, the idea that you would not want to use EBIT anymore to me is very concerning, because I think it'll inflate your business value and a lot of things, by doing so. So anyway, what I would say to everyone is, as Becco said, I think that is a red flag. You should be very wary of businesses that ever present anything with EBITDA. And I've seen additional letters that get added onto the D and the A there. So be very mindful of that, and always stick to the operating income and EBIT, instead of using these manufactured numbers, right? The other one that you can't really mess up is free cash flow. So using those three, I think, is a much better value valuation stick. Okay, so let's keep moving on here. How
let me just chime in just really quickly on that, Hari.
Yep.
So I think one redeeming factor in all of this is that prior to 2018-2020 cycle, they use ROE as the sole performance measure. So ROE, they just use return on equity. And
Yep.
as we all know, with return on equity, it kind of hides the fact that you have a lot of debt, right? You can really juice up ROE when you have a lot of debt. So it's a redeeming quality that they've used or started to use ROIC instead. And they're using ROIC as that in of itself is a redeeming factor in what when we're talking about this management incentive structure.
Okay, let's move on to shareholder capital. So we talked about the $2 billion that they generate in free cash flow, a market cap of $22 billion. What are they doing with that excess cash flow? Are they, and we've talked about how much debt they have. So they have excess capital there, after they're paying off all of their capital expenditures. What are they doing with it?
Yeah, so in terms of shareholder returns, immediate returns, there's dividend, and then there's a common stock repurchase. If you look at the prior numbers, the dividend, and also they boast the fact that they have always increased dividend quarter over or year over year. So in 2019, they have dispensed about $760 million in dividend payment, and in terms of share buyback, $1.27 billion in share buyback, share repurchase. So in all, about $2 billion returned to shareholder in two different ways. And recently, they committed another $2 billion repurchase program. Towards the end of last year, they committed another $2 billion of repurchase program. So that's something to note here in terms of shareholder friendliness, in terms of capital allocation.
So every year they're about reducing their share count by almost 5%. It sounds like.
Yeah,
which can be very significant going forward.
Yeah, really, their share count peaked in 2007. So 2007, 8. Yeah, 2007, 6. That's when it peaked, and then ever since then, it's been dropping. So for about 10, 13 years, it's been dropping from about 200,000 or 200, about 200 million shares to now about 150 million shares.
Okay. All right. Let's keep going on here. Let's actually move on to the valuation question. So I think if you want to kind of give us your assumptions that are going into this model, and then talk about what is your your price and your margin of safety price.
Yeah. So in terms of discounted cash flow, you always want to start with initial cash flow that is reasonable, right? Cash flow can fluctuate here and there. So what I did was I kind of took the average of the last 3 years of free cash flow, and I started with obviously you want to be a little bit more conservative when you're doing your analysis. So initial free cash flow, I pegged it as $1.8 billion. Um, and then the growth rate, I said for the next 1 to 3 years, you're talking about you know on average, I said about 15%, and then 13%, and then 10% terminal growth. So 15% for year 1 through 3, and then 13% for 4 to 6, and 10% for 7 to 10, and then discount rate of about 10%. Number of shares outstanding, as I mentioned, about 150 million. And then we talked about debt level and cash prior to this. So if we run the number, intrinsic value comes down to about $254 dollars per share. And right now, at the time of this recording, the company is trading at 155. And I'd like to point out that this is obviously a little bit generous in terms of growth rate, given the fact that coronavirus is going to really damage the business. So that's a caveat to this analysis. So if you have 50% margin of safety from that intrinsic value that we came up with, it's 130 effectively, 127. And right now it's trading at 155.
And just to the growth rate that you talked about here, you said it was 15, 13, and 10, right? What is the revenue been growing at, and what is the the earnings per share have been growing at?
Yeah. So if you look at the cash flow growth, free cash flow growth for the last 3 years, it was 21%. Last 5 years, about 11%. Last 10 year, also about 11%. So that's free cash flow growth. And if I look at the EPS growth, last 3 years, 20%. Last 5 years, 9%. Last 10 year, 20%. This is all compounded annual growth rates. So not just one time point to another. This is every year it's growing at about whatever the percentage that I just gave you. And then top line is growing at 10%, 3 years, 5 years, 4%, and the last 10 years, 8%. So it's, putting out some respectable numbers for, diesel engine manufacturer, in my opinion. And when you're talking about, something more relevant than top line revenue, like, for example, EPS or free cash flow growth, they're, as I mentioned, they're putting out pretty respectable numbers. Past 3 years, they're compounded annual growth rate of 11%. Past 5 years, 10%, and then last 10 years, again, about 11%. So that's where kind of my assumptions came in, 15, 13, 10%. Obviously, this year, next year is going to take a hit. So I doubt that it's going to be 15%. But yeah, that's where the numbers came from.
Yeah, and for those of you who are wondering how, you can get all of these growth rates, if you go to our website, valueinvestor.org, and type in Cummins, their ticker is CMI. And if you go to the margins, profitability, and growth tab, you can actually see historical growth rates and historical margins, as well as their profitability, return on equity, return on invested capital. So if you look at that tab, you'll actually see a lot of this data year over year, 3-year trailing, a rolling average of every 3 years, every 5 years, 10 years, and so on for every type of metric. And, the interesting part about this is that the earnings per share has actually been growing at a close to a 20% rate. And a lot of that is due to the reduction in the share count, right? And so, we saw this with Southwest Airlines, which, we, at the time when we recorded the podcast, it was pre-coronavirus, huge reduction in their share count was really what was driving their earnings per share growth. And Cummins has the ability to do that. They're never going to be, anytime they're purchasing shares on the open market, they're, going to be at a pretty good discount to the rest of the market, just because of the nature of their business. They're an unsexy, company. Uh, so this is a very interesting company that, if from that standpoint, that you can see actually pretty solid growth rates in the metrics that count, which is the per share metrics. And so, by reducing their share count, you can actually get a bigger chunk of the pie without doing anything else. So, this is definitely one of those share cannibal companies that we really like, because for doing nothing, you can essentially, even with limited growth on the top line, they can still grow the bottom line.
Yeah, absolutely. It can be very attractive in that light for sure.
So, I think we're not quite at your let's going back to your intrinsic value. You said it was around $250 a share. Was that right?
Yeah, 250 again with those growth rates, right? So, we can also just like discount the first growth rate by, we set it at 15%, but you can always play around with the number. So you guys can, feel free to do that yourself. But, given our growth rate, 15, 13, and 10%, intrinsic value came out to be about $250 per share. Yes.
Yeah, and on Friday, Cummins closed at $155 a share. So, we're not quite to a 50% discount. Probably need to be closer to $125 a share for that. But, you know, um, depending on how bad things come out on an earnings report, we may see some of those numbers show up again. Um, and they certainly dropped, when the rest of the market dropped below that 125 number. I think they dropped to as low as $115 a share. So
Yeah.
you could get them at a fairly significant discount.
Yeah. I just did something interesting, just to kind of prove our point here with the discounted cash flow analysis. So I just put in my calculator here 0% growth for the first 3 years. 0%. So negative growth this year, but next year it balances out to net zero. If you put that in and then keep the growth rate for 4 to 6, 7 to 10, 13, and 10, like we did, the intrinsic value comes down to about $174 per share. So net, margin of safety about 87%. So really, this company right now is trading like kind of in this scenario where the market is assuming that there's not going to be any growth, perhaps negative growth, more like, because we set 0% negative growth for the first 3 years.
Yeah, has the company issued any sort of guidance, or have they suspended guidance for the year? Or
I haven't looked at that. But one thing that I have seen is, um, kind of thinking about the long or short to medium term cash crunch. I looked at that, and really, bulk of their debt is due in 3 years. 2023, about 500 million is really due, and then before then, really not much. Principal payment due in 2020 is $31 million, and around there for the next 3 years.
yeah, and that's more than covered by cash flow
Yeah.
for a while. So it doesn't sound like there's any risk there.
Uh,
All right, well, I think we've done a pretty good job on covering this. It sounds like there's an interesting business here for further research. Certainly, something to put on your watch list, to look at, in the future. So, Becco, do you have any other thoughts about Cummins before we close out?
no, this just the last couple of words on the company. It is an interesting company. I mean, I think I just mentioned a couple of things. One is the beauty of value investing is that you get to learn about various industries. Like for me, Cummins diesel engine industry, I had no clue. And walking into this, you get to do a lot of research and understand the business, and get to see a side of industry and side of the world that you never had exposure to. So that's the beauty of value investing. I encourage everyone to do it. And the second thing is, this company is not really a sexy company like you mentioned, Hari. It's not a darling of Wall Street. Everyone's talking about Google and Apple and et cetera, et cetera. But there are, tons of companies out there that are producing respectable numbers like this company. And it's doing well in terms of, putting out numbers. So So I would say, keep your eyes out for companies like this. It could be interesting business and interesting business to invest in when the time is right.
All right. Well, that I think that'll wrap us up here. Just a couple of things. If you are interested in getting onto uh, having discussions with our community, you can send us an email, info@valueinvestor.org, and we can hook you up with a Slack invite so that you can talk to us. As we've mentioned before, and on this show, we have a website, valueinvestor.org, where you can do your own, start looking at companies and do your own research. We've been making that available to people on the Slack community to have them kind of test things out as we start building things out. Becco and I have done a lot of work on that, and we're going to continue to do a lot of work to make out a lot of new features that are there to help you guys to kind of understand what and find new businesses, to do your initial analysis, and then kind of dig deeper once you start finding companies that way. So a lot more to come here in the future. So we really hope that you can take a look, check out valueinvestor.org, and if you do so, please send us any feedback that you have. We'd love to hear from you about it, and so that we can also improve the website. You know, so yeah. Anything else you got, Becco?
No, that's it. I'm glad you guys are able to join us today. Hope you guys stay safe.